look at futures right now for the US majors. We have strengthened a little bit following a pretty much unchanged session despite the volatility yesterday following the Fed's move to cut rates and at least leave open the door to more cuts should they be required. Let's talk this through. Joining us now, Binky Chadha. He's the the chief global strategist, get the wording right, at Deutsche Bank. Binky, fantastic to have you on the show.
Pleasure to be here.
What do you make of the Fed yesterday?
I would argue they're essentially sitting, on the fence. If growth slows, they will cut some more. If growth does, it doesn't slow, they won't. Our view is a little different. Our view is very clear. Growth is slowing. Growth is going to continue to slow, and so they will cut as growth slows, and they will continue to cut for a little while longer after growth's bottom.
So you're far more worried than Jay Powell at least was letting on yesterday. How close to recession are we? Because I know you're one of those who thinks we're far closer perhaps than people realize.
Sure. There's two or three very simple points to make. I mean, if you look at the manufacturing sector in the U.S. and you look at the ISMs, I mean, we've been slowing from a peak back in September of last year, and it's a leap of faith to think that, something that's going down like this is suddenly going to stop here tomorrow and then start maybe to even, going up, number one. Number two, people say that, they sort of mix signals and you look at the bounce in services. But, I mean, if you do actually look at services and you look at the ISMs, I mean, they've essentially been coming down in a sawtooth manner. So the last two bumps did not sustain. I would argue, the U.S. economy is slowing broadly. It is slowing unambiguously. And I would argue that the U.S. economy is dangerously close to sort of tipping over into a recession. What I would argue is we are very, very close to what has historically been a stall speed for the U.S. If you look at the labor market, for example, payrolls growth, is running the 6-month change at an annual rate, running at about 1.3%. That is, number one, the slowest pace that we've had in 10 years at any point in this recovery.
It's bound to slow though when the labor market gets so tight. And I guess back to your point about manufacturing, it's still only, what, 15 to 20% of the U.S. economy. Are you saying actually that you're worried about the consumer too, despite things like retail sales, because of what you're saying about the jobs market?
So consumption growth is always going to be over, some period of time, tightly related basically to labor income growth, and the biggest component of that is jobs growth. Right. Now, just one additional point that I would make is payrolls growth in the U.S., has slowed from 2.5% in the middle of last year down to 1.3%. The services sector is much bigger than the manufacturing sector, as you just said, and most of that slowing has actually come from the services sector, not the manufacturing sector, because it is much bigger. We are running at 1.3%, and I would argue that the stall speed or tipping point is around 1%. If you look at private payrolls growth historically, going all the way back to the 1960s, whenever we've gone through 1%, we've ended up in a full recession.
What does this mean for stock markets? Because you're also arguing that there's a gap here, a gap between the fundamentals that you're talking about here and where stock markets are. If you're right on the fundamentals here, what kind of pullback are you talking about for stock markets potentially here?
So the things that I would point out are, number one, the U.S. stock market is about 15% expensive to where growth is currently.
15%.
That's right. I would put where we should be on the basis of, the ISMs and the like at 2,600, not at 3,000. Now, I do have a target for 3,250, and most people are confused by that.
Yeah, I am too.
What I would argue is that because U.S. economy is slowing, and it's slowing pretty severely, I would argue, we will get a relent on trade policy, and so my constructive view or V-turn in the stock market is predicated on getting a credible trade deal that would be very positive, and 3,250 then will look too conservative.
Very quickly, how long are you going to leave it before you change that call if we don't get a deal?
I mean, it's a call. We're very close to the end of the month, so I will accept,
throw the towel in.
Whatever on my face.
Custard.
Yeah.
Thank you. We have to wrap it there. Binky Chadha, the Chief Global Strategist at Deutsche Bank. Thank you so much. We'll get you back to discuss.